So in the 30-ish years that I've been in this business, this is the most mixed and uneven economy that I've seen. For every plus, there's a minus. And even within specific areas of the economy, you take housing, for example, you have the pace of existing home sales that are trending near 30-year lows, but new builds are doing better. Not great, but doing better because the market needs more inventory. And then even within the home building business, you have bigger builders that are taking market share and doing better than smaller builders, also because they have the ability to discount their product through either mortgage buy downs or other incentives. Take the consumer itself. You have the higher income consumer that's feeling better about their state rather than lower to middle income consumers because inflation affects them less than the lower income consumer. The lower income and even middle income consumer are focusing more of their spend on their needs, less so on their wants. They're focusing more on service/experiences and travel and restaurants and eating out rather than on stuff. So there's a mixed bag there. If you look at the manufacturing sector, well, it's been in a recession for about 2 years now. There's the hope that maybe this inventory destocking and the shift away from spending on goods has run its course. Maybe we'll get a period of inventory restock, but not seeing that just yet. We know an enormous amount of government spending has helped to boost economic activity on one side, where budget deficits of 6% of GDP is itself a natural lift to economic activity, particularly where that money's going. It's going into healthcare via Medicare, Medicaid. It's going to boomers and older retirees via Social Security payments. It's going to the defense sector, and it's going to those that hold U.S. Treasuries via interest income. So that flows into the broader economy. And then you also have the government-induced spending on manufacturing facilities to make chips and EV batteries and so on. But even that money, we'll have to see what the payoff is of that, because there's one thing to build a facility, there's another thing to actually make a product at an affordable price that you can then sell. So you combine all this together, and to me, it feels more like a 1.5% type GDP growth rate economy rather than something that's around 3. And then I'll layer in a lot of the company conference calls that I listen to, and if I had $1 for every time I've heard challenging macro environments, and not just the quarter that ended for Q1, but all of last year, I heard that too. Now, what that means for inflation and the Fed, it definitely creates a conundrum, because the Fed can lean on the softness in encouraging them to cut, but then they can highlight the strength. One last thing I wanted to add on the economy is the labor market. Labor market itself is very mixed. You have an unemployment rate of 4%. On one hand, it's historically very low, but in the other, it's the highest since January 2022. And if you look at the trajectory of the unemployment rate, it's definitely ticking higher. If you look at the JOLTS data, if you look at initial claims and continuing claims, if you look at plans to hire within the NFIB survey, if you listen to what ZipRecruiter has to say in their earnings over the last bunch of quarters, the demand for labor is shrinking. The pace of firings, on the other hand, notwithstanding the last couple of weeks of a tick up in jobless claims, still remains somewhat muted. So even within the labor market, there are a lot of mixed signals. So overall, it's a confusing environment to try to figure out. So layering on top of that is what's going to happen in the rest of the world. Since U.S. GDP is only about 20% of global GDP, you have European economies that are mixed. Manufacturing in Germany and France and other parts of the region are challenged, but the tourism industry in Italy and Spain and Greece, Portugal seem to be doing great. So a mixed bag there. Look at Asia. You have India growing 7 to 8%, but China's growth rate dramatically slowing down. You have Japan, which is showing signs of hopes, but little GDP growth. Southeast Asia is doing better. I think putting this all together about what happens from here, I think that U.S. growth is more likely to slow from this 1.5% pace rather than accelerate. And a lot of it has to do with this continued digestion that I think that needs to take place in terms of our economy adjusting to this higher rate environment. And the higher rate environment is actually helping some parts of the economy, like those on fixed income, where they can actually get some interest income. And you see that in the cruise line numbers, for example, because that's where they're spending their money on. But on the other hand, I think that the higher interest rate environment, which historically speaking, rates are not that abnormal. What is abnormal is that it comes after 15 years of zero, that there's still a lot of debt that comes due in the coming years that businesses via debt maturities, households via ARMs, adjustable rate mortgages that are maturing, that need to reprice. If you're in commercial real estate, you know the pain that you're dealing with if your debt is coming due this year, where the rate on that loan was probably priced before 2022 at a rate nearer 3% rather than the 8% now on offer. So there's still this period of time of debt maturities that I still think that we need to chew through. That's going to be painful for anybody that has debt coming due. The world needs more equity. It needs less debt, but that is a long-term process, a multi-year process for us to work through. And also you're still dealing with the cumulative impact of higher inflation. I don't discount the possibility of inflation inflecting up again, particularly on the goods side, which could cause some pain. We've seen container shipping prices that are literally skyrocketing again, which is leading to higher air cargo costs that will then soon filter into higher manufacturing costs. And if manufacturing globally is bottoming out and we're going to start to see an inventory restock again, you could see prices there rising again. And I think it's so confusing for the Fed as well. And why they will likely cut by the end of this year. It's not just going to be a typical rate cutting cycle where they're just going to slash and burn in response to a slower economy like they have in the past, because I think inflation, even though it's moderated, very much ties their hands in their ability to react to challenges. It'll have zero impact on the economy. And I'll even argue that if the markets start to believe that this is the beginning, it's not just one, it's actually going to be a progression of cuts because the unemployment rate continues higher. If the long end of the bond market starts to worry that the Fed has shifted their focus to employment from inflation, you could see a couple things. You can see weakness in the dollar, which can then regenerate import inflation and higher commodity prices, particularly higher oil prices. The long end of the curve may say, why am I buying the 10-year here at 4.25 if the Fed is now getting cute and cutting interest rates on the short end? And you may see a situation where the yield curve steepens in a bear steepening way where short-term interest rates fall, but long-term interest rates rise. So Fed cuts here a much difficult maneuver and threading of the needle than the Fed has had in the past. So it's a much more complicated situation here if the Fed does go down that path. So in the 1980s, people were whining about the rising U.S. debts and deficits, and people were calling for ever-rising interest rates because of the crowding out that the government was taking over in terms of capital, and the dollar was going to tank, and so on and so on. And here we are 40 years later, and we asked the question that you just asked, when will it matter? And the reason why I think now it matters is because I think bond bear market started. The bond bull market bubble peaked when we had $18 trillion of negative yielding securities, driven by the genius, I say very sarcastically, of the central bankers who thought that negative interest rates, nominal negative interest rates, was a good idea, which I refer to as the dumbest idea in the history of economics and monetary policy. Here we are, the backside of that, where fortunately we don't have any negative yielding securities anymore, with Japan being the last holdout. And I think in this new higher rate environment that countries can't get away with rising debts and deficits like they once were. And we sort of got a taste of that with the Bank of England last year, with this liability-driven investment that caused a panic with pension funds and the spike in gilt yields that the Bank of England had to step in. We got a taste of it the last couple of weeks with worries about the French parliamentary elections next week and what that can mean. So it seems that the market is more sensitive to fiscal recklessness. And this time may be different than what we've seen over the last 40 years, and that, yes, maybe we are in a bond bear market, and that ever higher interest rates could be upon us. Now, we haven't seen really the effect yet. The Treasury is still selling the debt that they need to raise at these auctions. Now, granted, a lot of the auctions over the past 6 to 12 months have been pretty mediocre at best, with the occasional good ones, but mostly mediocre to poor ones. But you just wonder, when is that failed auction going to take place? When's that bid to cover going to be less than one? And I can't discount that possibility, because the problem right now with the budget deficit and the money that the government needs to borrow, as seen by the CBO, which raised its budget deficit estimate by $400 billion for the U.S. Treasury to near $2 trillion, is that higher interest expense and the non-discretionary spend that is on autopilot, that this just continues to compound and gets worse and worse. And you also wonder about this sort of bipolar economy and geopolitical world that we're sort of creating, with China on one side, the U.S. on the other, and countries wanting to use dollars less to transact in critical minerals and oil and other commodities. So all these things come together, and I do think that this now matters. Now, in terms of Congress and the president actually doing something about it, to me, a 6% 10-year will cause a crisis and a panic in Washington that maybe would be the trigger for them to respond in some way to the excessive and reckless spending that we're seeing on both sides of the aisle. Well, I talked about earlier just the maturity wall of digestion that we have to work through over the next couple of years in terms of lower cost debt repricing at higher interest rates. Imagine if those interest rates that they need to refinance into is even higher than it is today. That will be extraordinarily painful. If we do think that 21, 22 times PE ratio for the S&P 500 is expensive, it'll feel even more expensive with a 6% 10-year rather than one that's closer to 4.25%. So there could be a lot of pain involved in that. And then it also ties into where the stock market goes, because we talk about the economy, but we sometimes forget to understand how influential stock prices are to the economy. I talked earlier about the higher income consumer that's doing better, the baby boomer that's doing better. Well, I will argue that they would not be doing better if the S&P 500 was at 3,000 instead of 5,500. It would be a much different consumer type behavior. So where the stock market goes in response to where interest rates go, where earnings grow, where the economy goes, is itself a driver of where the economy is going to go, at least a part of the economy for those people that own stocks. Because these baby boomers, they're still heavily involved in the stock market. So while they may be benefiting on some of their savings, getting 5% interest income, a drop in the stock market would be painful offset to that if it were to occur.